let's make good on the American people's mandate by taking President Trump's America First vision and this America First policy agenda and making them a reality in the lives of our fellow citizens.
We are writing checks we cannot cash, and our children are going to pay the price.
US lawmakers debate President Donald Trump's self-declared Big Beautiful Bill. It's meant to cut taxes and raise spending on the military and border security. And analysts say it'll add somewhere between $3 trillion to $5 trillion to the nation's debt over the next decade. But is that a problem for the United States? It is, after all, the world's largest economy. Let's try and find out. It's what we do here on Reuters Econ World. Every week, we pick a phrase or buzzword and go deep on the economic principles and ideas driving the biggest news around the world. So this week, budget deficits. I'm your host, Carmel Crimmins, in Dublin. A budget deficit, also known as a fiscal deficit, is when a government's expenses exceed their revenues. It means they aren't raising enough in taxes to pay for all the things they're spending money on. So they have to borrow to make up the difference. In the early part of the 20th century, very few industrialized countries had large budget deficits. But the First World War changed that. Deficits grew and governments borrowed heavily to finance the war. The British economist John Maynard Keynes argued in the 1930s that deficit spending during a recession was a good thing. It could help revive demand and economic growth. But running fiscal deficits over long periods can lead to a jump in debt levels and higher interest rates. And that can crowd out private investment and mean higher taxes in future to pay down the debt. So where does Trump's tax and spending bill fit into all of this? Supporters say it'll boost economic growth. But analysts from across the political spectrum say it will deepen America's fiscal hole. I spoke to Reuters financial columnist Mike Dolan to find out more. Mike Dolan, how's it going?
Hello, good morning.
Mike, budget deficits aren't inherently a bad thing, right?
In and of themselves, no, not necessarily. It depends on where the money's going. I think that's what people would say. Governments have to, unlike many other borrowers, and there's often false analogies made between the household budget and the government budget. The government has taxation for years to come. And if it needs to invest and build bridges and roads and schools and hospitals today, then it's perfectly sensible for it to borrow today to invest, given its guaranteed future taxation stream. So government deficits per se are quite routine. Mm-hmm. But there is a point clearly at which they stack up and they mount, and the overall debt of a country, usually measured against its annual GDP, starts to become burdensome.
Have we reached that point with the US? I mean, they haven't run a surplus since 2001.
No, and the last significant fiscal retrenchment, to use the wonks term, would be probably Bill Clinton in the 1990s.
Yep.
And there have been a number of very major crises. We overuse that word, but there have been 2 or 3 pretty substantial financial and natural disasters over the past 20 years, which have seen the scale of the outstanding debt explode. And we're now talking about $36 trillion, mm-hmm. which is at 100% of GDP this year in terms of debt to GDP measures, and projected by the non-partisan groups like the Congressional Budget Office and even private credit rating agencies like Moody's to be hitting 130% or so in a decade. So, and further on, if you keep going, you can obviously extrapolate that beyond.
Yeah.
Is it unique? It's unique in US history in the sense that I think it peaked in World War II, just above this level where we are now, and was brought back within within 10, 20 years of World War II, it was drawn back to more reasonable levels. But the US is not unique internationally. I think the most obvious example is Japan.
Right.
And we have debt to GDP ratios well in excess of 200%. That's not necessarily a good thing in the sense that it's not necessarily a good comparison, but it shows that, there isn't a magic point at which all the alarms go off. The economy comes to a standstill.
Mm-hmm.
People have argued for years about at what point it starts to drag on economic activity and growth. There was some suggestion that anything above 100% of GDP might do that. But those numbers have been challenged and are open to some considerable debate.
Right. I mean, certainly the thing about the US is it's always been able to fund itself pretty cheaply, something that's known as exorbitant privilege. Are things changing there?
Yeah, I think it is. I mean, the exorbitant privilege, which was that French jibe from the 1960s, essentially is the kind of ubiquity of dollars around the world. The dollar is the world's most dominant currency, both for savings and for trade and business generally. And because of that, countries around the world tend to hold very large amounts of their own savings and reserves denominated in dollars, and that creates a certain automatic demand for US debt, for US treasuries.
Right.
That has allowed the United States to perhaps run much higher deficits at much lower cost than it would otherwise.
Mm-hmm.
And certainly fiscal conservatives in DC would argue this is part of the problem. In fact, it is this huge amount of surplus capital from the rest of the world that piles into the United States and reduces the cost of that capital that has expanded government beyond all reasonable size. But nevertheless, because of that use of the dollar around the world and because of the size of the US Treasury market, ironically, makes it more liquid and is a deeper market than many other comparable sovereign debt markets.
Right.
Then the US is a different case. It's a special case. There's no doubt it is a special case.
But we are seeing borrowing costs climb, right? And also federal government interest payments as a percentage of GDP is ticking up.
Yeah, no, absolutely. And this is a different environment. I think a lot of people would argue very cogently that we were in a little bit of a strange moment after the banking crash of 2009, and that 10 years of relatively slow growth and low inflation allowed the Federal Reserve in particular to loosely underwrite Treasury borrowing. But after the pandemic, we've entered a different world of certainly higher inflation and arguably different dynamics around the world in terms of supply chain pressures and other things that may make the cost of borrowing generally, both central banks, what they are setting, and also the financial markets in the bond markets, that they would be at a higher plane and a higher level. Now that changes budget maths when you're looking at those projections we were talking about.
Yeah.
So over 10, 15, 20 years, you just have to add very small amounts into the average cost of borrowing on debt piles of over $30 trillion.
Yeah.
And you start to see that mount up. And the higher the debt servicing cost is usually the bit that really makes people alarmed.
Right.
There's a really interesting statistic out there from the conservative historian Neil Ferguson, who keeps pointing to this data point where when debt servicing costs rise above your defense spending,
right,
then you usually at the end of the road or end of an era. He looks at various empires over the last few hundred years, from the Spanish to the Ottomans to others, where that metric actually proved to be a turning point. So it's a challenging statistic because it's just happened in the United States last year.
What about the big budget package, Trump's big, beautiful bill?
I think that the bill is really interesting because of the reset that the Trump administration is trying to do. So in theory, you can look at the Trump team's approach to the budget and to the debt in a number of ways. And they would argue very clearly that they are cutting government and therefore there will be significant savings. There is a very tense and often confusing battle going on at the moment in the House around just to what extent it is cutting. But there's no doubt with the Department of Government Efficiency and all of the federal worker cuts that have been happening, that there is an attempt to do that at least.
Right.
It is falling well short of projections. They were talking about 2 trillion. I think Elon Musk, who was topping that department to begin with, talked of $2 trillion worth of savings from these cuts. I don't think we're even close to 200 billion at this point.
Yeah.
But that is one of their arguments. The second argument is they raise revenue from all of these tariffs that have been barreling around the world and causing all the disruption for the last 2 months. Again, I think you can see some of the monthly numbers show that those revenues are rising, but the overall annual take from that would be, I think at best guess from some analysts, $400 or $500 billion, which is about 4 weeks of federal spending. So you can see what they're trying to do. They're trying to reorganize government around a different model for spending and taxation. But of course, they also want to cut taxes, and they also want to reduce the revenue streams in that light. So these are multiple moving parts. By any private estimate, the budget deficit itself will be 6 to 7% of GDP next year. So on paper, this budget deal that's being thrashed out in Congress at the moment will add anywhere from 2 to 5 trillion, depending on which cut of the numbers you think eventually gets passed.
Yeah. And there's a number of key hurdles coming at us over the summer, right? Like that will sort of determine the economic outlook for the US over July and August.
Absolutely. We still haven't resolved the tariff issue, of course.
Yeah.
And so the financial and economic anxiety around that will resurface almost certainly come June, July. In that moment, we also have that endlessly recurring debt ceiling problem.
Yes, the Groundhog Day. Yeah.
Which is one of the key reasons why the credit rating has come under such pressure, is because of this strange, almost self-inflicted process of having to go back to Congress every year or every 18 months, every time that the debt hits the limit, and have to raise it mechanically in nominal terms. And that process comes through the summer. Again, we'll need to raise the debt limit, or there need to be agreement to raise that debt limit by the end of July, or we hit the so-called X date in August, which is when the government runs out of money.
One of the things that affects a country's ability to fund its budget deficit is its credit rating. A credit rating helps investors work out the risk of buying a country's debt. A AAA credit score is the highest rating you can get. It means the country is in good financial health and can easily repay its debts. And that typically translates into lower borrowing costs. This month, the US lost its last AAA credit score when Moody's downgraded it. The other two main rating agencies, Standard & Poor's and Fitch, had already removed America from the AAA club. It's a good real-world example of the pressures around America's finances. And you know, we do like a good real-world example on this show. So Mike, this downgrade, it wasn't a surprise, right?
They had the rating on credit watch for the past 12, 18 months. So it was a move that was expected. And the only way that this would have been averted, I think, from Moody's point of view, would have been some significant change in the budget profile, or indeed in the process around the debt ceiling, which is definitely an irritant for many of these credit rating agencies, because you bring the market to the brink of a technical default, which is exactly what those credit rating agencies are supposed to warn against.
Back in 2011, when S&P became the first agency to cut the US's AAA credit rating, the market reaction was severe, but the Treasury market actually rallied. This time around, we're seeing US government bonds fall, meaning the yields have ticked higher. What's different about 2011 versus now?
I mean, the argument at the time was ultimately that if you create a great burst of volatility in financial world in general, that in effect you create the sort of environment where people tend to go and look for safety, and the only safety is in the long end of the US bond market. That sounds like a circular roundabout argument, but that was at play, that there was a bigger concern about technical defaults that were happening in around the debt ceiling, for example, happening and disturbing finance generally, rather than the long-term credit quality of the United States per se, and therefore you just parked your money whenever you got a slightly higher return. I'm not sure that always applies. And I think you can see today that that was not the direction of travel of the long end of the US Treasury market. So presumably it's the moment and when it happens. And I think right now it's a nervous moment for all the reasons that we've discussed around trade and a new administration and lots of slightly chaotic policy making that I think everyone is watching with great degree of anxiety.
If the US is more at the mercy of the bond vigilantes, what can they do if they do need to get investors on side, if they do need to calm markets, if the summer does become, hot for all the wrong reasons?
You get into, I think, a lot of how the Treasury manages its day-to-day funds and how it manages its debt issuance. There are quarterly refunding schedules that the Treasury can change and reorder in a way that takes certain pressure off certain parts of the market. So that's one way. And it's managed to keep things relatively stable in the last couple of refunding announcements. The other thing that's almost certainly going to happen, which is not necessarily good news, but is that the pressure for the Federal Reserve to come to the rescue, as it were, by reducing the base cost of money in terms of its policy interest rate, then that's going to increase.
Yeah.
And you can see it almost daily coming from the White House. Trump now has almost a steady stream, ticker tape of abuse that he throws at the embattled Fed chair from his social media accounts. And the pressure on the Fed will be enormous if the Treasury market is in deep trouble. And you can see where that tension can build, and you can see where that could compound the problem also, because the more political pressure is brought to bear on the Fed, the more people get nervous that the Fed has control over inflation, and the more you get a sense that its independence and its functioning is being frayed to some degree. And I know Trump already said he would not fire the Fed chair in his current term, but he does have to renew that term next year. So there is mounting speculation that Trump will install a Fed chair that's more loyal to his thinking about interest rates.
On the political side of things, taxes could be increased and spending cuts ramped up, but politically, that's hard to do.
Yeah, I mean, this is people's great fear. If there is a genuine concern about why government debt and rising deficits over time really becomes a problem, even for a country like the United States.
Yeah.
It's because it's quite easy to build up spending. At least it's easy politically to do that. It's much, much harder to rein it back in. And the vast majority of the US budget is baked in. It's Medicare, it's health, and it's Social Security, and large chunks of it, of course, on military and defense. These aren't cuts you can make very easily, and they're certainly not cuts you could make without a great deal of political fallout from them. And if you're down to 7 votes in Congress and you have Congress people going back to the polls in 18 months' time, then you see how sensitive that will be as a process. But it is very difficult to get that back down. It is extremely difficult to make significant inroads. What people would hope for would be some form of bipartisan commission that is sent about how you bring the deficit down, or you bring US fiscal profile back into shape in ways in which the CBO and others would suggest it. But bipartisan anything in DC these days is almost impossible to imagine. So we are at the mercy of the markets in terms of telling us when this is going to be a problem. And in that regard, that's where markets potentially fulfill some significant function in it, because if they do balk at ever rising US debt, and if there is a big spike in volatility in markets, then much like in the early 90s, when Bill Clinton was forced to change tack on his budget, it was indeed the bond markets who triggered that move. And perhaps at that point, Congress realizes that there is a problem and does something about it.
A big thank you to Mike. If you want to understand markets and the economy, check out his columns on the Reuters app. Next month, they'll also be available on Reuters Open Interest. a new product that's going to be your one-stop shop for financial commentary and analysis. That's launching on June 9th. Sound design, music composition and engineering on this episode was by Alex Summer. Our podcast team includes Kim Vanell, Tara Oakes, Gail Issa, Josh Summer, Christopher Walljasper, Jonah Green, David Spencer and Sharon Reich-Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.